Welcome. It's a pleasure to continue what is the second time and therefore a tradition of the IMF, one of the major IMF reports being presented by a joint venture of the Graduate Institute Geneva and CEPR. And it's also become a tradition, Giancarlo, for you to be our main commentator on the fiscal issues of the world. So thank you very much to Raphael Espinoza, who is the Deputy Division Chief of the Fiscal Affairs Department of the IMF, for agreeing to present some parts, the analytical parts, more of the Fiscal Monitor that has just been launched a few weeks ago. And thank you, Giancarlo Corsetti, who needs no introduction, for being our commentator. But, you know, I was looking at this report and noticing that the IMF has not changed in some respects, because it continues to be a place where you do not exaggerate your titles, right? I mean, a title that one could have imagined for this report in this particular moment in history would have been something like the highest mountain of debt ever, and how are we going to deal with it? At least that's the way that I personally experience people's worries and the questions that they have on the outgoing leg of the pandemic, at least in advanced countries, when they look at the fact that everywhere they look at, the mountain of debt has clearly increased, and they ask and they worry and they ask, how are we going to deal with it? So this is really a big part of what we will be hearing about and discussing during this hour. So without further ado, let me move to that. Just one housekeeping remark for those of you who are now in the audience. We do have time, and we will make enough time for questions and answers. So please use the question answer function on your Zoom that you know well by now. You should also remember to be early with your questions, because if we cannot get to all the questions, the earlier ones and the ones that get the voting up ones are going to have priority. So without further ado, I pass over to you, Raphael, for your presentation of the Fiscal Monitor of the IMF of October. Thank you.
Thank you very much, Beatrice, for the introduction and for inviting me again and organizing this event again. It's really a pleasure to see you and Giancarlo for this event. Let me share my screens. In the meantime, let me kind of comment on your statement of the title. So the reason why we chose this title is because we really thought that strengthening the credibility of public finances was indeed one of the ways to address the mountain of debt that you mentioned. And we think that the mountain of debt creates these difficult policy trade-offs that are still very present in policymakers' minds. And these trade-offs, we think it can be made easier to manage when countries have credibility, because it really helps them buy some precious time. And the point of the report is to explain what I mean here. So we know that during the pandemic, fiscal policy played a very supportive role, but the crisis is not over. And for many countries still struggling to contain the pandemic or just coming out of it, fiscal support to protect the recovery still appears to be essential. At the same time, fiscal buffers are being eroded. The right-hand side chart shows the effect of the pandemic on public debt, which refers to what you were mentioning, Beatrice. For advanced economies, the increase in debt is quite impressive, 18% of GDP last year, and this jump in debt appears to be higher for advanced economies than it is for emerging markets and low-income countries. And an interesting question is, why is that the case? It's not really that the emerging markets or the low-income countries suffered less from the pandemic, or that they did more to preserve buffers. this divergence really reflects that these countries at lower levels of income had less capacity to increase their borrowing. So they already faced tight budget constraints at the beginning of the pandemic, and you can imagine that the challenges they face now are not getting easier with more debt. So the objective of the chapter is to help us understand how countries can strengthen the credibility of their public finances to sustain these higher levels of debt, whilst keeping a low cost for growth of whatever measures will be taken to strengthen credibility. And we'll focus in particular on something we call fiscal frameworks, which are the set of institutions and rules that guide fiscal policy and that help governments communicate their fiscal strategies to financial markets and also to the public. To give a few components of fiscal frameworks as examples, these include debt or deficit objectives that have been announced, maybe in the context of fiscal rules, also the existence of independent institutions that monitor fiscal developments, etc. So designing fiscal frameworks is going to be one of the topics that we'll cover. But before going to that, we first have to determine what a good fiscal objective is. And that comes back to the question of what we'll do with the debt. The second point we want to highlight before thinking about fiscal frameworks is that there are fiscal risks that countries are exposed to that could lead to even more debt going forward. And we have to understand what are the sources of these risks to understand how to manage them in the context of the fiscal frameworks. And so the last part of the presentation will focus exactly on the components of the fiscal frameworks that we think are important for credibility. But let me go back to your point, Beatrice, on the level of debt by showing a bit of some distributions of how debt has evolved a long time and across countries. You can see the left-hand side chart shows how this density of the debt levels have shifted to the right. So with more debt for all the countries that we survey in our database since the financial crisis, since 2007. And in 2020 and 21, debt was really increasing quite quickly. And this was mostly because of falls in growth, but also higher deficits. You can see the right-hand side chart showing gross financing needs, which are the sum of deficits and rollover of existing debt. And there was a big jump driven by the deficits, which we'll talk about later on because it's a source of vulnerability as well. Fortunately, debt has been quite cheap until now, thanks to the global environment of low interest rates. And the middle chart shows that the interest bill of governments as a ratio of GDP has barely changed since 2019. And actually, this is true for all country groups, even though there is some underlying trend in low-income countries, especially of interest expense creeping up over 6-7 years. So since we talked about low interest rate, let me focus a bit on those because this is really an important development in the question of the debt strategy. Very simply, if interest expenses are lower than in the past, debt levels higher than they were in the past can be sustained. But this raises two questions that I'm addressing in this slide and in the next slide. The first question is whether in the past low interest rates have indeed led to a reduction in debt. And when we looked at the empirical record, as shown on the right-hand side chart, we found that low interest rates are not a silver bullet at the relevant policy of horizon of 5 to 10 years. So you can see in the chart that countries displayed below the horizontal axis are countries for which the interest rate was below the growth rate. And for those countries, natural automatic debt dynamics tend to bring debt down. But at the same time, we find a lot of countries that are below this horizontal axis and that are still above the 45-degree line, for which primary balances were sufficiently negative that they're more than offset any benefit coming from interest rates being lower than growth rates. So you have a lot of countries in the Great Triangle, and this means that at a policy horizon of relevance, which is here in this chart, is 10-year, we're doing 10-year averages, debt can still increase even with interest rates being lower than growth rates. The second question on interest rates is whether we really can assume that these interest rates will stay low for a long time. This has a component of risk premia and a component of safe interest rates. Here I'm going to focus mostly on risk premia. And we see that these have been, we know that these have been relatively stable since 2019, even though there have been a few sovereign defaults that have happened. And several countries, especially emerging markets, but not only, are under the scrutiny of markets. And in fact, when we look at the drivers of risk premia and we regress risk premia for debt for a panel of countries, we find that the sensitivity of spreads to debt has declined since 2017. This is what the red line in the right-hand side chart shows, which is the sensitivity of risk premia to debt. And in the report, we know that it's quite possible that this is explained by global factors, such as quantitative easing, and last year, the huge increase in excess savings as consumption was restrained by mobility restrictions. Indeed, when we controlled for the global factors, we found that the sensitivity of risk premia to debt has mostly remained constant, which is the blue line in that chart. The issue is that these global factors are not well identified, and therefore we cannot assume that we know what is driving these effects. And in particular, it's possible that tightening of monetary policy in advanced economies could raise both safe interest rates, but also reduce the appetite for risk. So all of this is to say that given that the sensitivity of spreads and risk premia to debt is not well understood, we cannot guarantee that interest rate will remain low and risk premia will remain low as the crisis evolves. Which leads us to the question of the strategy for deficits and the fiscal path. It's useful to think through the kind of fiscal effort that would be needed to rebuild fiscal buffers going forward. Now, we know there are no obvious answers on the debt path. Macroeconomic theory provides different answers according to the models used. And empirical models have found that although high debt is a problem, there is no specific debt threshold above which debt reduces growth or increases the probability of crisis, especially, particularly dramatically. In fact, the value of reducing debt by, let's say, 10 percentage points may not even be very high in terms of reducing the risk of crisis. And doing that effort could take quite a long time. In the left-hand side chart, we show some illustrative calculations that even if primary balances were substantially higher than in the past, let's say 0.5 to 1% of GDP higher for advanced economies and emerging markets, it could still take 20 years to bring debt back to 2019 levels. So it's really a marathon, not a sprint. And this is what justifies the value of committing to reducing debt over a long horizon. And for that, it's useful to run a theoretical model of sovereign risk premia to understand the benefits of commitment. The theoretical model, which is in the tradition of Eaton-Gersowitz, models of sovereign default, is calibrated to a typical emerging market, and it allows us to compare the risk premia, or the spread, if you want, that a country pays as a function of its ability to commit to reducing deficits in the future. So the first blue bar in the right-hand side chart shows that undertaking fiscal consolidation immediately indeed reduces spreads, but it really comes at a cost for the recovery, at a cost for employment. This is shown in the red dot being quite negative. However, when the country is able to commit to reducing deficits in the future, spreads also fall because the creditors care about the capacity to repay in the long run. But because the fiscal consolidation is postponed to better times, employment is protected, and so the red dot is above the zero line. Of course, the key practical question is, how can countries commit to be responsible in the future? One way is structural fiscal reforms, for instance, for pensions, subsidies, public employment, or reform to public wages. And these reforms could start when the recovery is underway and there is political appetite for them. Governments can also pre-legislate changes to other taxes or spending. And finally, they can design fiscal frameworks that embed deficit reduction in the future and that are credible. The bottom line of this slide is that for lenders to be willing to support for a potentially long time high levels of debt, credibility of fiscal plans and resilience to shocks of these plans is essential. Which leads me to the question on the risk to debt going forward. Indeed, debt often jumps in the aftermath of crisis as well as during crisis. And we know that in this current crisis, there's still considerable uncertainty about the evolution of the pandemic. In addition, many countries have taken risks with their balance sheets by developing large corporate support programs or implicit guarantees to state-owned enterprises. The world is also more prone to natural disasters, including because of climate change. So it's important to quantify the risk to debt. The chart shows that over the last 25 years, unexpected jumps in debt, which we looked at 5-year horizon projections from IMF projections, these surprises to debt were around 15% of GDP and even larger for low-income countries. And among the most important factors driving these jumps was disappointing economic growth. Its contribution is shown in the middle panel, and also stock flow adjustments from the debt dynamic equation. And these stock flow adjustments are driven by exchange rate movements, exchange rate depreciation, but also sometimes by bailout of private or state-owned enterprises. So knowing this fiscal risk is important for the design of a fiscal strategy for several reasons. First, fiscal objectives should build buffers for these risks. The larger the risks, the larger the buffers. Second, the institutional coverage of our fiscal frameworks should also include the source of these risks, for instance, state-owned enterprises in low-income countries. So it's also important that budgets include expected losses so that governments understand well the cost of their policies when they design them. Finally, policymakers should also think about risk mitigation policies, for instance, putting caps on guarantees, etc. Let me now move to the third question of the report, which is the features of fiscal frameworks that help improve credibility. So to give a few more examples of fiscal frameworks, these are now quite complicated, so they have several features. These include announcement of long-term fiscal objectives, medium-term budget frameworks, procedural rules, which can govern how the budget should be prepared and executed. But numerical rules are also important in many countries. And finally, reporting and external oversight of fiscal developments is crucial for communication and for enforcement. So fiscal frameworks need to have all of these components, and the goals that they should try to achieve are present in the chart on the right and include 3 objectives: fiscal sustainability, that's of course a primary objective, but also stabilization of the economy, and finally simplicity. And simplicity is essential for communication and for enforcement. But the way this chart is displayed is to display as a triangle because it's a trilemma, right? We think about it as achieving the 3 objectives at the same time is really challenging. And the trilemma has a graphical way to present that. Now, changing circumstances can lead countries to choose different points in this trilemma. After the global financial crisis, countries realized that their fiscal rules were difficult to enforce and didn't allow enough space to undertake fiscal expansion during a crisis. This led to a revision of fiscal rules to what has been called the second generation of fiscal rules, which I've placed at a different point in the triangle because they put more emphasis on stabilization and therefore countercyclical fiscal policy. But this also came at a cost in terms of complexity of the rules and less control on debt. The pandemic is one of these shocks that also could lead to a rethink of fiscal frameworks. In particular, many fiscal rules were already suspended during the pandemic. And so countries have to consider whether to reactivate an old fiscal rule or to adopt a new rule. And maybe some redesign will be necessary, but it's important not to throw the baby with the bathwater. Strong fiscal frameworks and numerical objectives have contributed to lower deficits. The left-hand side chart shows that fiscal authorities that are constrained by debt rules are more likely to prudently take measures to reduce debt after a shock that increased it. And these results are obtained from estimating what is called the fiscal reaction function that relates fiscal deficits to past debt. And these regressions find that after an increase in debt, countries that follow debt rules tend to increase primary balances more than countries that do not follow debt rules. And similar results can be found also for countries that follow deficit rules. So the bottom line is fiscal rules seem to deliver on what they are intended for. However, they do not have to be focused on debt. In fact, many economists, in particular Jason Furman and Larry Summers, have argued that pre-COVID debt objectives are not too conservative because of the low interest rates we talked about. In general, setting a fiscal objective in terms of the interest bill could be more appropriate because the interest bill is a good measure of the cost of debt for the government. And the proposal has its advantages, especially in countries that are not exposed to rollover risk. But the majority of countries still need to manage rollover risks for their stock of debt. And in that case, the debt objective is quite valuable as an information on the vulnerability of the fiscal position. A related issue for emerging markets is also that a fiscal rule based on the interest bill could end up being more pro-cyclical than a debt rule. The right-hand side chart shows that the interest bill is more sensitive to the cycle than the debt to GDP ratio for emerging markets. That is, when we look at the right-hand side part of that chart, the red dots tend to be more negative than the blue bars. And this is because interest rates tend to rise in recessions in emerging markets, whereas for advanced economies, which are on the left part of the chart, interest rates tend to fall in recession, and therefore the argument, of course, goes differently there. Maybe the debt rule is more pro-cyclical in advanced economies. So when we look at the second component of the trilemma in this triangle I was showing earlier, that is how to allow fiscal policy to be countercyclical, there are a range of proposals. Some of them are old, some of them are new. And one of them is to focus on procedural rules that have the advantage to move away from arbitrary numbers. And this can be effective in countries with strong fiscal transparency and fiscal oversight, and where there is a large constituency, for instance, in parliament, that supports fiscal responsibility. Another option is to use expenditure rules. These constrain the growth of government spending, but allow government revenues to move with the cycle. A new proposal has also been to allow for larger deficits when monetary space is constrained, which is often the case in these days, and that's an issue actually for this proposal, because the question is, when does the situation come back to the normal? Finally, another proposal is to recalibrate existing rules with higher ceilings of deficits, but it's not clear what the impact on credibility of recalibration would be. On one hand, revisions of rules can improve the credibility of the framework because adhering to an unrealistic target increases the likelihood that it will be violated in the future. On the other hand, revising the target may signal weaker commitment to fiscal sustainability. The limited experience we have suggests that context and communication is key. So for the report, we did an extensive analysis of the media reaction to the suspension of fiscal rules that were taken last year, and these shown in the right-hand side chart. We find that newspapers' reaction was actually quite positive in all countries. So we looked at the media sentiment calculation for newspaper reports around the suspension of fiscal rules. And most of the countries have relatively positive media sentiment. So the vertical axis is a meaningful number to look at here. And this is because the pandemic provided a good justification for suspending fiscal rules. Even then, countries with more transparent communication benefited from positive reporting, and that's why we find this positive slope in this chart. So communication and context is really important. Let me move to the third objective of fiscal frameworks, which is to be sufficiently simple so that it helps communicate on fiscal policy and build its credibility. To check if fiscal rules matter, we first needed to build a measure of the credibility of budgets. And we did that by comparing official projections for the deficit, as documented in budget announcements, with private sector expectations for the deficit, which are available from consensus forecast for a range of countries. So this is a natural measure of credibility because it has a parallel with the measure we use in monetary policy, where we compare the official target announcement with expectations for inflation by the private sector. Interestingly, we found that fiscal rules and the existence of fiscal institutions that help enforce such fiscal rules indeed help improve the measure of credibility of budgets. So on the right-hand side chart, this gap between official announcements and private forecasts tend to be positive because the government tends to be more optimistic than the private sector. But as we keep adding fiscal rules or fiscal institutions such as fiscal council, this gap becomes smaller and smaller. Now, why do we care about this credibility metric? Well, there are two immediate benefits, and this brings us back to my initial comments on the difficult trade-off that countries are facing between, on one hand, supporting the population during the recovery period, and on the other hand, preserving some fiscal space for future shocks. So the first benefit is that predictability of fiscal policy is important for the private sector for spurring investment and growth. There is a good literature on that. And so if the predictability of public finances is higher, this will improve growth, and it will make the parameters of these fiscal trade-offs for governments less painful, because everything is easier when growth is stronger. And the second reason why credibility pays off is even more direct, and it comes in terms of lower interest rates. We show in the left-hand side figure that there is significant correlation between funding costs and the credibility of budgets. More specifically, these gains seem to be indeed related to the effect of credible communication of the budget, because when we looked in the right-hand side chart at sovereign yields around the time of budget announcements, we found that most of the gains occur in the month where the budget is announced, and the fall is quite significant by around 40 basis points. So these are tangible benefits that improves government's challenges, government's trade-off they are facing going forward. So what are the key takeaways of the report? To summarize briefly, debt is high and creates risk, and this means that fiscal consolidation at some point will be necessary to reduce debt, but it should really wait until the recovery is on a strong footing. And this is why fiscal frameworks are important, because they can buy time. They make fiscal policy more credible, and this eases financing. Now, what exactly features of fiscal frameworks should we adopt? Well, this is really country-specific and period-specific, but we want to emphasize in the report that numerical rules have worked as intended, even though it's important to keep in mind stabilization and simplicity. Finally, reforming fiscal frameworks will be more successful if they allow for some flexibility to accommodate the current conjunctural situation, which is quite still difficult in many countries. It's also important to build political consensus and to ensure fiscal transparency, because this pays off also in terms of communication. So thanks very much for your attendance and your interest.
Thank you very much, Raphael. And I give the floor now to Giancarlo Corsetti for his comments.
Just sharing my screen. I don't know whether people can see my screen.
Yes, we can. It is loading.
Okay, so thank you for having me. It has been second times, maybe a tradition for me to discuss the fiscal monitor this year, like last year. As usual, great reading, highly recommended to everybody. This year is particularly challenging because it comes at the time where pandemic and crisis is far from over. And also, on the one hand, we can say, okay, we actually, it was not that bad. We avoided a global meltdown. On the other hand, if you look at the divide in terms of vaccine, finance, rising poverty, there is no reason to be happy there. And the problem is even complicated by the fact that now there is the urgent need to address climate change. And there is the legacy of the previous crisis. Now, coming back to the opening salvo by Beatrice, today, basically, we are sitting on what's going on here? 256% of global debt. including public and corporate and households, with many countries with policy rates still constrained at the zero lower bound. And we have these two imperatives, right? Investment and inclusiveness. Inclusiveness in terms of employment, in terms of poverty, income, investment in terms of addressing the public good nature of the problem that we face, pandemic, digitalization, the infrastructure, and of course, the transition to the green economy. So it's a complex policy problem. And the monitor this year is sort of ringing a bell and saying it's about time to think, however, already about the fiscal leg of what can take us through, the fiscal leg of resilience. So my point is that we discovered a few years ago that we are not as resilient as we thought. And what is the new model of resilience is still unclear. We need to buy time for adjustment, and we need to rebuild a credible policy framework at the same time. This is very clear in the euro area, but it's a global problem. So the message is very important from the monitor. It's a marathon, not a sprint. But somehow we need to re-anchor expectation through long-term objective institutions and procedural rules, transparency and communication. Now, I want to make 3 comments on these issues, a little bit inspired by the fact that we need to rebuild resilience. We don't know yet what would be the new balance between different instruments, from fiscal, monetary, regulation, supervision. And my point will be that if we don't find a way to cooperate internationally, times ahead are very green. This is a time for international cooperation, and is the best international public good that we have. And to make clear, this international cooperation is also on the content of fiscal policy. I don't have much time, so let me just go very quickly with some fleshing out some issues. In the Geneva report last year, we sort of came to discuss this idea that in a time of crisis, both the fiscal and monetary policies are complement to each other, not only because they need to push the economy in the same direction, but because what one does, create fiscal space, monetary space for the other. Policy space is created by each of them. And what maybe in the Geneva report was not very clear is that there is no miracle coming out of this complementarity if the two policies lack credibility. So to create fiscal space, monetary policy need credibility. To create monetary effectiveness, fiscal policy need credibility. And this is difficult. It is difficult because the situation is complex. And I'm not going to repeat the Geneva report, but it's written there if you want to see it. What I just tell you one example of the problems. If you read papers on the ECB or papers also written by many people, one of the proposals around is the idea that once monetary instruments are constrained, fiscal can come in to help achieving demand and inflation, to keep inflation at target. But to do so, there is this idea that in a deflationary scenario, fiscal policy must commit not to raise surplus in the future against deficit today. And monetary policy needs to commit to target, to sustain the value of government bonds. So by all means, in normal times, these two behavioral prescriptions would be labeled irresponsible. You raise deficit without raising taxes in the future. You target the value of government bond. That's monetary financing, right? Now, those are not normal times. Inflation is below expectations in many countries. It could be a way to bring demand and inflation back to target. But how you communicate this policy, including the fact that when the times will come back to normality, you reverse to some other models of interaction and engagement. You can see all the political economy aspect of it in this passage, coming from, like making monetary policy easy condition for fiscal borrowing, etc., etc. So I see this problem quite complex to handle in a framework. So this is like really a core problem for rebuilding credibility for many countries. I skip over the experience of the UK. We know that being tough, talking tough about the future and spend today is a fantastic, if it is credible, is a fantastic combination. The point is that sometimes talking tough about the future in a state of uncertainty is dangerous, because at some point the recession may go much longer than you expect. And all of a sudden you have a problem. The recession is still there. You promise cuts, you promise austerity at the time where the recession is still there, and it's complete nonsense to implement those plans. But once people understand this, credibility is becoming a big problem. And today, remember, a source of risk is coming directly from monetary and fiscal balance sheet for many reasons. So let me come to in a way to the center. So if Beatrice stop me, you get the message. My problem is that, we have been listening to Blanchard and other people who have been convincingly arguing that we need to take advantage of a window where R minus G, interest rate minus growth rate, is low or negative. There are many important reasons why that is the case. And especially at the end of the day is excess saving and low investment. But what matters at the end is a global equilibrium in which countries will be R minus G's plus lambda, high lambda, low lambda, high risk, low risk. And these two lambdas are not independent. It's actually, it will come in the global equilibrium, then naturally we split, countries may polarize into high risk and low risk countries. And remember, high risk means low growth, because it means basically borrowing conditions become problematic and you cannot really finance growth. Low lambda means high growth, because you cash in the capital flights, the search for safety. So how do we stop the economy, the world economy, to go prematurely into a polarization of risk? Now, I just show you, I don't have time to comment on this, but this is something that Yoon Shin is taking around. The blue is domestic currency and the red is foreign currency debt of emerging market. You see that at the time of the COVID scare, international market dump local currency debt by emerging countries. Now they're back, but they only lend, international markets only lend in our currency. Original sin is still there. Even when you see this domestic currency, if you look at the yield there is different from the hard currency yield, meaning that the interest rates are different. So at the end of the day, there is still this original sin there, which is part of the low lambda equilibrium. So this is the challenge for the IMF, multilaterals. How do we think of an official liquidity and bailout regime that help the leveraging and help adjustment at this point in the next 10 to 20 years? So, for example, what are the debt sustainability standards? Even like a small adjustment, debt versus flow, liability flows could be important. And the other complication is that there is a strong supply side to the problem. I mean, we need to keep the income and activities up after the shocks that we have experienced and we will experience in the future with climate change problems. So I would expect at some point a fiscal monitor talking about a sort of a global compass on debt and fiscal policies, kind of a new arrangement where the fiscal leg coming out of seniority of single countries is met by an international commitment to make sure that whatever path is chosen can be pursued without the risk of being derailed by global meltdowns in financial conditions. And I conclude very quickly that what is expecting us is actually kind of complicated, because remember, many of the fiscal engagement in investment or health or digitalization or green economy have a strong public good nature. How you finance it, where to find the management and factive legs for implementing them. So I think we need to go quickly into sort of a Copernican revolution in public finance, from being at each other's throat when the budget is defined, to be very disciplined in understanding whether the money is spent the way it should have and what are the effects of the spending. This is necessary also because part of the problems that we have in front of us are unclear. So we need to have a way to monitor for good management the way fiscal policy goes and help sustaining the denominator of the famous ratio, debt to GDP, apart from containing the explosion of the numerator. I'm sorry, I may have gone a little bit above, but I stop here. Thank you for your attention.
Thank you very much, Giancarlo. Yes, you have raised a number of very important questions, and of course, Raphael is very keen to answer all of them. Let me just add a few that have either come in through the chat or through my own my own interest and preference. So Giancarlo also mentioned the issue of the original sin, and that graph was definitely something very impressive that you showed us. Original sin is back big time. And we have a question also from the question answer saying, isn't this actually the challenge that for many countries the debt is to start with in hard currency? And the second question that relates to that is, would a lending in local currency by multilateral organizations not be a solution? So, Raphael, there's a challenge for the IMF. I have a few more challenges for you. I'm trying to sharpen what Giancarlo said about it would be nice if the IMF came up with a framework that had targets. So let me sort of, raise that challenge to you. You in one chart you said, well, if we wanted to get back to the levels of debt of 2019, that would take X numbers of years. I think it was 20. But the question really is that the right measure, or why would it be the measure? In Switzerland, the pre-pandemic debt to GDP ratio happened to have been 27%, and some people are thinking we should go back there. So, more on the target would be good. And the third question I wanted to throw your way is a little bit related to that. In the European context, that sustainability analysis is having a big role to play in the discussion about how to reform the Stability and Growth Pact. Your appendix shows, to this chapter, shows something that you did not have time to mention, but it shows a rather weak performance of that sustainability analysis tool so far. Can you also comment on that? So, floor is yours, Raphael.
Thank you, Beatrice. I mean, these are a lot of questions. And it may not be the best way for me to touch on each of them very superficially. Let me think which ones, I think are more important. Let me start with the original sin, which I think is really interesting. What it was also a very striking chart. We know this literature from Weder and others about the graduation on a pro-cyclicality of fiscal policy towards counter-cyclicality. I think a big part of it might have been that during the GFC period, emerging markets were actually able to do countercyclical policy. And so, just if you do a rolling correlation, you start seeing this shift from pro-cyclicality to countercyclicality. And part of it was thanks to the reserves or the buffers they had, right? So they were actually having fiscal space at the time. And they were able to do quite significant policy support during the GFC. I wonder if a lot of this space was consumed and not rebuilt between the GFC and now. And one of my first chart that I show is how emerging markets didn't do that much compared to advanced economies in terms of the fiscal support. And that's really concerning because, again, they had a pandemic that was as bad as the advanced economies, but they did much less because there was what we have been calling a financing divide, the capacity to raise finances. So this suggested to us that rebuilding space is actually important. And so that comes back maybe to your second question, which is the target. If we want to rebuild capacity to react against future crises, we probably have to bring that down back to some number. Now, let me differentiate though the advanced economies or the Switzerlands of this world compared to many others, right? I think we cannot put all the countries in the same basket, and that's why we also try to avoid from having a unique target. And it's something that we really discuss in a bilateral surveillance with country authorities, what the right debt strategy. We don't think there is a unique objective like 2019 number. That was just an illustration. And the reason is because every country will be in different situation with respect to their fiscal risks. And their fiscal risks are multiple. They come from the financing side. So again, what Giancarlo was mentioning on the original scene is really striking and interesting. But at the same time, countries that do finance themselves in local currency at the low interest rate that are prevailing right now, and as Giancarlo was mentioning, are likely to prevail for a while because of demographic trends. Then it's difficult to say debt is the right objective because debt of 2019 might have come at a higher interest rate than debt today. In fact, I think debt in just before around 2000, I think debt around 2005, the cost of debt was much higher for many countries than the cost of debt now for many advanced economies. With debt numbers that were half of what they are now, you had a higher debt cost for many advanced economies. And so we've at least had a period of 15 years with a burden of debt that is actually much lower than it was in the past. So then why do I care about the accounting number, the value of the bond, if what matters is my interest bill? But again, that comes back to something I was mentioning, the difference between the interest bill and the financing needs. And I think that does talk to different vulnerabilities for different set of countries. There was a comment on the DSA, the EU DSA. Can you, Beatrice, can you repeat that? Because I only wrote European DSA and I don't remember the exact question.
Oh, the question is simply the DSA. So if we don't have a target, I agree, then we need a framework for establishing sustainability, and the DSAs are this framework. But your analysis seems to suggest that they're not doing a very good job. So
yes, so thank you for reminding me. So in the report we have this box that looks at the capacity of the European Commission DSA and the IMF DSAs to kind of correctly identify the mechanisms that lead to higher debt. And so we find that the DSAs rightly identify the mechanism of the growth channel, for instance, that when real growth underperforms, you get higher debt. That's something that we identify well, especially at the short horizon, less so at the medium long-term horizon, but that's always going to be difficult in general, everything long-term. So we think that the DSAs do relatively well with growth scenarios. We think they don't do very well. One of the channels they don't do very well is the nominal channel, the GDP deflator channel. And this is not something that is necessarily studied in detail when we look at interest rate shocks. But interest rates can go up, or real interest rates can go up because nominal interest rates can go up, or because GDP deflators or inflation undershoots. And that's been a source of vulnerabilities in some countries that analysts have to keep in mind. So that's something we mentioned in the report. Finally, I want to react to something that Giancarlo mentioned. I think is very important, which is, in a sense, the quality of spending. And he was mentioning, like, we have to do a good assessment of the type of spending. This is something that we have worked extensively at the IMF, especially in the Fiscal Affairs Department, in the context of public investment. And it's a big topic right now in Europe with the recovery funds, but in many countries, especially as we are thinking about public investment in the climate change challenges that we're facing. So having a high quality public investment is really fundamental. In fact, it was a topic of last year's report, if you recall. Something we often mention is that investment inefficiencies in the management of public money for public investment can lead to loss of 30–40%, so really inefficiencies in how the money is used. This is work by some of my colleagues that show that looking at a wide range of countries. And so that suggests that indeed focusing on the quality of public investment and doing more with less is going to be really important. Thank you.
Thank you, Raphael. Giancarlo, did you want to react to anything that you heard?
No, I agree. I just want to make clear how complex the situation is. It's also intellectually complex. The DSA needs fresh thinking. The European area experience, the Euro area experience, shows that maybe it may be good to move a little bit towards flow assessment, so the financing need, the flow assessment management. There is a passage in the monitor that sort of says, well, no, long maturities help. That's true, subject to two caveats. Now, long maturities of public debt also correspond to short maturity of QE. So the assets and liabilities of the public sector as a whole may be shorter than we think. And with Fred Maing, who was actually in the audience, we sort of rethink all kind of possible belief-driven crises that are economically feasible, economically a possibility. And long maturity is not necessarily a shield for all of those. Some of those actually may happen also with long maturity. So we need to be extremely careful to see the new world out there. And again, to me, rethinking the essay, rethinking the content of fiscal policy. Remember, it's also rethinking the governance of the money, right? Because in many countries, some of the money may not go where it's supposed to go. But especially rethinking the effectiveness of the spending will be important. Especially so when we don't know, frankly speaking, we have no idea about the way certain investment may turn out. No, it's a little bit, jokingly I say, we would need a public sector venture capitalist helping the public sector to get, the right innovation in green technologies, the right innovation in, there are many things we frankly speaking, we don't know how well they will develop. Let me stop here.
So maybe this gives us the opportunity to address some more questions from the Q&A. So for instance, Marendo Muller is asking, what do you, Raphael, IMF, suggest can be done in order to stabilize fiscal credibility in the face of different political trends and new governments? A very easy question to which I'm sure you have a very easy answer. Why don't you go with that one while I read the new ones coming in?
So one example on credibility is this idea of announcing now some measures that will kind of yield benefits in the future, right? So they don't immediately cost you now in terms of growth, in terms of the support packages you have, but they have a long-term effect. So we mentioned things like pension reform, like public sector reforms, wage bill reforms, things that do have quite a permanent effect on the public finances. And it's important to have measures that last, and it can be small numbers, but over a very long time is better than a big number today. Something we mentioned in the report is that the private sector only gives you credit for about 1/3 to 1/4 of what you're announcing for fiscal consolidation next year. So when we look at official announcement of budget deficits and compare them to the private sector expectations for the deficit, if you're doing a big fiscal adjustment next year, the private sector gives you on average 1/3 or 1/4 of the credit for that. So it's not really the way to go, right? It seems to be the way to go is more to have long-term frameworks that really gives you this deficit reduction in the future. So that would be one of the main suggestions that we have. Also, the set of, as we mentioned, the set of rules and that help communicate on your objectives, that help build the political backup for having fiscal sustainability is really important. At the end, most of these countries, the way it's going to work is the political support has to be there. The constituency for fiscal sustainability has to be here. So fiscal transparency that document well the cost of the measures and the consequence for debt, for fiscal risk is really, really important.
Thank you. And here is one more question from the Q&A that actually was voted up. It is on something that you addressed squarely in your presentation, sort of your impossible triangle, but where do you come down? How to ultimately integrate a sufficiently large flexibility with the stability that creates the credibility? What is the actual recommendation?
Yeah, so I mean, there is this, and there is a combination with the simplicity as well. Again, because as I was mentioning, to build this credibility, you have to be able to communicate to the public so that this constituency is well informed, right? So it's three objectives, not two, and that makes it even more challenging. As we note in the report, countries have moved even a long time. I mean, you shouldn't change all the time your fiscal rules or your fiscal frameworks, but it's legitimate that there are some structural changes, like the global financial crisis, like the pandemic, that lead to rethinking of where to be in that trilemma. Some of the recommendations that we have been pushing for at the IMF for a while, and they're not for all countries in any case, but for some countries they work well, is expenditure rules. Because expenditure rules, if you anchor the path of government expenditures to nominal GDP, you're going to have a stable source of expenditure a long time. Nominal GDP can be reasonably well estimated at a medium to long-term horizon, so you kind of anchor your expenditure on that, and then let the revenues fluctuate with the cycle with automatic stabilizers. So that combination is a typical recommendation we make for countries like Europe. But you may need also combining with escape clauses. So what was happening last year, where the crisis is so big that even such a rule is not flexible enough. So in this case, you want to have something like an escape clause that allow you to deviate from the rule for some time, address your emergency. Then there are questions whether there is a well-specified mechanism to end the escape clause. And that's something we often talk with country authorities to try to think what is the best way to come back to the rule after the escape clause. I also want to mention that the crisis is so big that it does raise a question whether you need a transition period from now on until you're back to some kind of steady state. Right, it's not necessarily the best idea to implement a framework and say we're starting from 2022 on a new framework. Sometimes it's useful to accommodate the post-crisis. Again, this crisis shouldn't happen every 5-10 years, so maybe we need to give some additional flexibility for that one.
Well, let's hope that this kind of crash doesn't happen every 10 years. Although it's probably better to prepare for such a risk. I am afraid that we have exhausted our time. I thank the audience for attending. I thank Raphael Espinoza for presenting and discussing, and Giancarlo, you have raised many additional questions that we should discuss further, in particular the joint credibility of fiscal and monetary policy, since right now we have just had major central banks announcing a new, more flexible monetary framework. We are in Europe at least in the middle of a discussion about the fiscal framework. All of these big anchors are being repositioned, and all of it, as we were mentioning, in the middle of something that is still far from over. In the middle of a pandemic. I would say we live in interesting times. Macroeconomists definitely do. Thank you very much for being with us today. And your questions that we were not able to address, we will send to Raphael. Thank you and bye-bye.
Bye-bye.
Thank you. Bye.